Hello, my name is Michael Joyce from JoycePayne Partners, and I'm pleased to share with you today our viewpoint for the fourth quarter of 2015. We've just come through a period where most of the financial markets had a pretty serious correction. It's the first market correction really that we've had for 3 or 4 years. And some markets, such as anything related to energy and natural resources or the emerging markets, have been in a bear market. And a bear market is defined as when investments are down over 20% from their peak. However, to be clear, we do view this as a correction, not as the beginning of a bear market. We've also seen an increase in volatility, and this doesn't surprise us at all. This is something we've been talking about for the past couple quarters. In our view, the volatility over the past couple years has been abnormally low, mainly due to the Federal Reserve's unprecedented quantitative easing program. However, they've taken their foot off the gas, so we have seen an uptick in volatility. A lot of people associate volatility with risk, and that's not always the case. I mean, if you have an investment that, say, goes up by 20%, and you sell it after 6 months, that would be considered a pretty volatile investment. But is that a risky investment? I think that most people are more concerned about downside volatility, and more specifically, the risk of permanent loss. So I'm going to talk a lot today about both risk and return, and I'm going to start off by really geeking out on you for a little bit and maybe giving you some nightmares from your long forgotten college statistics classes. But if you think about investment returns as having normal distributions, as is shown here, and you have an investment that has a long-term annualized return of 10% and a standard deviation of 20, that means that in most years the return is going to vary in any given year from minus 10% to plus 30%. That would be one standard deviation, and we can say that with 68% confidence level. However, the returns in some years are going to be in the tails, and if you have a 2 standard deviation type year on the downside, that means that this investment could have a return, in this example, of minus 30%. However, if you put 2 investments together that are not highly correlated with each other, and what I mean by that is that the returns don't move up and down in tandem and they move in different proportions, you can actually reduce the volatility of the portfolio. That's why we're big believers in diversified portfolios. We think that with diversified portfolios, over the long term, you can get superior risk-adjusted returns. So how should we think about returns? The venerable father of value investing, Benjamin Graham, once said that in the short run, the markets are a voting machine, but in the long run, the markets are a weighing machine. So what he meant by that is, in the short run, you can have some investments that are popular and go up, and some that might be out of favor and go down simply because they're going up or going down. But over the long term, if the investments have good fundamentals and good long-term growth, they're going to perform better over the long term rather than the short-term popularity would indicate. Another investor, Howard Marks, who's the head of Oak Tree Investments and the head of the investment committee for the Wharton School's Foundation, has said that many market participants are so worried about trying to predict other market participants' behavior that they ignore value, that they avoid unattractive investments, or they avoid investments that they think will be unattractive. But other investors who can think independently and can endure maybe some short-term pain of unpopularity can pick up some very attractive investments at bargain basement prices. What's important to our clients at JoycePayne Partners is achieving their long-term goals and objectives. And for a long-term objective of, say, having a comfortable financial independence, a comfortable retirement, I have never seen somebody not achieve that goal because the returns were too low. Typically what has happened is they either didn't save enough money, or they spent too much money, or there was an unexpected event such as divorce or unexpected long-term care needs. What's really important as a measure of how you're doing towards achieving your long-term goals and objectives is not so much your nominal returns, the returns from year to year, but rather it's your real returns. And what I mean by your real returns, I'm talking about your inflation-adjusted returns. The return premium that you get each year over the long term over inflation. So if you think back in the 1980s and you had a portfolio that had an average annual return of 8%, there might have been 5% inflation through that period, so you had a 3% real rate of return for that period. And right now inflation is much lower. The Federal Reserve's inflation target is 2%, and indeed over the past couple of years the returns have actually been below that. We're not at target. But let's assume that inflation is going to be 2%. To achieve that same real rate of return of 3%, you need a 5% nominal rate of return. So the most important measure of how you're actually progressing towards meeting your long-term goals and objectives is this premium that you can get over inflation over the long term. I've been very pleased to share with you our viewpoint for the fourth quarter of 2015. To learn more about what we're currently thinking, please visit our website at www.JoycePaynePartners.com or follow us on Twitter at JoycePaynePTRS. Thanks and have a great day.